Good morning everyone and warm welcome to the AddLife third quarter report. As usual, we will take you through the numbers and description what has happened in the company during the quarter. Then we will open up for a Q&A session, and after that, as usual, we encourage you to stay on for a few more minutes to see an interesting video from one of our companies. This time around is from Healthcare 21 Ireland, a very important piece of the puzzle as we are growing throughout Europe and an important platform acquisition. So let's get going with the highlights of the third quarter. So the AddLife companies all had a good quarter in the third quarter of 2025. We saw a strong EBITDA improvement in both business areas. We saw a healthy customer demand. Currency adjusted growth increased by 7%, 6% organic, and a nice addition of 1% from acquisitions. The growth in Labtech was really strong, 9% excluding currency effects, and on the Medtech side, a very healthy demand in spite of the fact that we are updating our product portfolio and we saw a little bit of a weakness in capital sales. So 5% growth in Medtech, a strong quarter. We are driving profitability improvement initiatives in a handful of companies. These are progressing quite well, but there is more work to do, and we think there is more potential to improve the performance of some of the companies within the group. We're pleased to note that we have achieved our net debt to EBITDA goal of being below 3. We stick to that goal. That's a good target for us, we think. But of course, now that we are below that level, we can increase the acquisition activity. So with that, I hand over to Christina to take us through a little bit more of the details of the financials. Welcome, Christina.
Thank you, Fredrik. So the companies within AddLife delivered solid revenue and EBITDA growth in the third quarter. Organic and acquired revenue growth was 7%, and organic and acquired EBITDA growth was 20%. EBITDA has been adjusted for revaluation of contingent considerations and also restructuring costs relating to Camanio. This is 7 million in total and relates to last year. The FX had an impact of 3% negative both on the revenue and on the EBITDA growth side. So total sales growth was 4%, of which organic growth was 6%. Labtech delivered 9% and Medtech 4%. We also had acquired growth of 1% that relates to Edge Medical and is within Medtech. We had stable gross margin and also strong cost control within the companies. Compared to last year, we also had a positive impact on the OpEx side from the closure of Camanio. In total, that was 10 million. The EBITDA margin summarized to 11.1, up from 9.8 last year. And we had significant lower interest costs in the quarter, 30 million. But then in financial net, we also have exchange gain and losses. And with the loss this quarter and the gain last year, it was a total of minus 12 million comparing year over year. But the profit before tax increased with 164%. And profit after tax improved with 228%, since also tax rates is coming down. So the EBITDA margin between the quarters can vary a bit, and normally Q3 is the seasonality lowest one, but EBITDA margin is definitely in a positive development. And if we look at the EBITDA growth, it was 17% over last year, and the year-to-date EBITDA margin was 11.9 compared to 11 year-to-date last year. And the improved EBITDA margin comes from both Labtech with 11.2 and Medtech 11.6. Also, normally operating cash flow is slightly slower in the third quarter. This year it was 145, and accumulated operating cash flow was 504 compared to 429 last year. Cash conversion remains high at above 90%, and we are still focusing on inventory reduction and working capital efficiency. So working capital was negative 143 million. Inventory increased slightly, mainly due to preparation for an expected strong Q4 sales. Looking at inventory towards revenue, that has remained at a stable level throughout the year at 16%. Also, account receivable increased. That was due to strong end-of-quarter sales, but also we had somewhat slow collection due to vacation period, expecting to recover in the fourth quarter. The acquisitions relate to purchase price adjustments for Edge. The net debt was improved with 52 million, and with loans being majority in euros, we always have an FX impact. This was limited this quarter. When we look at net debt, we include the bank loans, leasing liabilities, contingent considerations, pension liabilities, provisions, and then we deduct cash. So that is the total of our net debt. So with net debt decreased and last 12-month EBITDA increasing, leverage declined to 2.9. This means that we have reached our ambition we set up for ourselves to be at 3 or below. And as said before, debt will be reduced through self-generated cash flow. The interest rate in the quarter was 3.8, below last quarter's 4.2 and significantly lower compared to last year's 5.7. We have two covenants, interest coverage ratio and equity ratio. Interest coverage ratio should be above 4, that was 7.9 in the quarter, and equity ratio should be above 25%, and that was 42, meaning that we have solid and increasing headroom to the covenants. And with that, I hand over to Fredrik again.
Well, thank you very much, Christina, for that thorough review of the numbers, and now we move into the business areas. So starting with Labtech, had a strong quarter with 9% growth and strong EBITDA margin development. Demand in diagnostics is stable and growing, and as we have talked about in previous quarters, we do have had fantastic success with tenders, both new and renewed, and that helps us to grow but also to improve margins, and we see that effect in this quarter as well. Demand in pharma remains high, and that is, as you know, an important customer group for us. There is a hesitation in academic research investment. We've talked about that in the past. There are, however, some signs of improvement in this quarter, so we're pleased to see that. So that's great news. Also great news is good progress that we see in gene sequencing. This is an area that we have really prioritized. We are active in it in multiple parts of Europe, and we see very strong developments, in particular in Southern Europe, where we have been driving together with customers significant projects that are now coming to fruition. We have added new products, both in Southern Europe but also in Central and Eastern Europe, and we see good progress also in the Nordics. So great progress with an important area of gene sequencing. So moving on to MedTech. We had a nice quarter with 5% growth, and of those 5%, 1% came from acquisitions, which is nice. EBITDA margin improved significantly to 11.6%, and even though the demand is somewhat lower normally in the summer months because fewer surgical procedures are scheduled, we had a healthy development. In UK, however, a little bit lower. There is uncertainty about budgets, there is uncertainty about capital spend that we have discussed previously, and that still continued, unfortunately, in the third quarter. We are working very diligently on continuously evolving the product portfolio towards more advanced and more high-margin products. And in some cases, we see a little bit of a decline on the top line as we remove some of those projects in that process. We wanted to also share with you a somewhat new perspective of our market coverage. So looking at the map, you can see here we have a quite unique pan-European coverage. Of course, with a strong presence in the Nordics, but over the years we have taken conscious and strong steps to establish ourselves all across the European markets. So we're not only strong in the Nordics, we're strong in Western Europe, Central and Eastern Europe, and Southern Europe. And this gives us some really important benefits. Of course, we have an access to a bigger market, both in terms of sales, but also in terms of acquisitions. We have more supplier opportunities driven by our strength as a company. We have access to a broader range of acquisition targets, and of course, with that, more attractive multiples. And this is further underlined by the fact that we are also active in both medtech and labtech across all these regions in Europe. So we got into this very strong pan-European position by making a few relatively large platform acquisitions. And I want to speak a little bit about those two, primarily Healthcare 21 in Ireland and UK, and MBA in Spain and Portugal. So starting with Healthcare 21, this acquisition was made in 2021, and since then it has developed very nicely. As you can see here on the slide, the revenue development has been an impressive 35%. So this is now a company at around 2 billion Swedish in turnover. And this has been driven by continued addition of advanced products. Not only has the company grown in a fantastic way, EBITDA margin has improved significantly, 2 percentage points, and is currently at around 14% EBITDA margin. So that has been driven by continuous efforts in efficiency improvements, an increased share of advanced products, and of also pruning of products that don't have the profitability profile that we like to see. We're extremely proud of the fact that the profit over working capital, as you well know, an important metric for us within AddLife, has improved significantly as well. This has been done through a range of efforts, renegotiation with suppliers, stricter inventory management through improved processes and systems, but also, I would say, market-leading collaboration with our partners to ensure efficient payments. Healthcare 21 has also contributed nicely as a platform for acquisitions with O'Flynn Medical, Emmet Medical, and Edge Medical. So all very good acquisitions that have been added throughout the years. So a great example of our geographical expansion and also improvement, solid improvement in the performance of this company. So moving forward to MBA in Southern Europe, Spain and Portugal mainly, an acquisition that was done in 2022. Also there we've seen a fantastic revenue development, getting close to 100 million euros in turnover, 25% growth since the acquisition. And this has been driven by continuously adding advanced products and supported by industry-leading service and support. We have also organized the company in 3 divisions that has really enabled an accelerated growth. EBITDA margin improvement has been fantastic, 3 percentage points up since acquisition, and now above 18% EBITDA margin. And this is, of course, through growth in high-margin advanced products, but also a very consistent efficiency and cost control work. And then finally, profit over working capital, again, an important topic for us. That has improved tremendously as well within MBA. They have a fantastic forecasting process. They have improved and have now a very tight inventory management process, and they are also very good in managing payments. So these acquisitions, MBA and Healthcare 21, have not only enabled us to become a much more pan-European player, they have also improved their performance quite a bit, and they are a platform for future acquisitions. So moving forward, I also want to share with you a little bit of an overview of the product portfolio that we have, the different categories in our product portfolio. This is a new way of showing this data, which we haven't done in the past. But what it really highlights is our unique strength in advanced products. So looking at the top of this slide here, we talk about specialist devices and equipment. These are advanced specialist products that often comes with proprietary consumables and service revenues as well. This really requires advanced training and technical support, and often also on-site clinical and patient-specific support. So requires a very competent organization in the field. These are products that are very differentiated and have a high value to the patient and the healthcare system. And you can see some examples of these products that we have in the portfolio. They are more than 70% of the revenues within medtech. We also have what we call medical supplies. These are more volume products, oftentimes at lower margin and oftentimes used in surgical procedures. They include products like infusion, transfusion sets, respiration, wound care, surgical procedure packs, and so on. And for AddLife companies, these are an important piece of the puzzle, around 29% of revenues. We try often to have these products within our own manufacture or own brands to further improve the margins. So this gives you a perspective of the product portfolio that we have, and this is something that sets us apart from competition as well. With that, we are about to conclude the presentation about the third quarter results. And I want to underscore that the companies have been doing a fantastic job in this quarter. So thanks to everyone involved. You're doing an important and great job. So in short, we have seen a significant margin improvement. We have seen a solid organic growth. Profit has improved, both in terms of margins, but also further strengthened by lowering interest rates and reduced debt, improving the bottom line performance as well. We have reached our ambition to be below 3 in terms of net debt to EBITDA, so we're very proud of that. And of course, this strengthened position allows for us to gradually increase acquisition activity again. So a good quarter and exciting times ahead. So with that, we're opening up for Q&A, but I would also like to encourage you again to stay on to see a great video about Healthcare 21 in Ireland. Thank you very much.
Hello everyone. I want to start by apologizing for the technical challenges we faced this morning that delayed the conference call a little bit. So thanks for hanging in there and listening to the presentation. Now we're opening up for questions. I see that a few of you have already raised your hand. So maybe we start with Matthias. So please unmute as well. Oh, there you go.
Yes. Thanks so much, Matthias Ekblom, Handelsbanken. A few questions, please. I'll take them one by one. So thanks for the insight to MBA and Healthcare 21. You didn't share it for AddVision. What would some of those KPIs have been in terms of sales growth, EBITDA margin, and profit through working capital? We understand they're not as good, but and maybe not exact details, but interested to hear some of the similar metrics, if you may.
Yeah, sure. I think one day we will show a fantastic graph, of the development of AddVision companies as well. As you do know, that it has been a bit of a rougher ride. We have reduced the top line of around 10 million euros because of the pruning of the product portfolio. So it's taking us from 70 to 60 roughly. And then margins that were supposed to be in the double-digit area are not. They're in single-digit now. But there's a continuous improvement. We are really working diligently on that, and that's the way that we work. And I hope that we can show a nice set of graphs for AddVision companies soon as well. But right now it's below what we had expected it to be. But our ambition is certainly to drive that back again into double digit. Be a smaller company, more focused, smaller, but again into double digit margin. That's for sure the ambition.
Perfect. Thanks so much. And you spoke about the weakness or the softness on the capital sales for MedTech. So could you quantify how capital sales for MedTech performed in the quarter, or if better, year to date?
Well, I think that's really a comment relating to the UK market in particular. And that's where we see hesitancy around capital sales. So I would just, for simplicity, use that the UK number. Because I don't think it's something we see in general across Europe. So UK effect, we've seen in the past, it continued in the third quarter. We have shared previously that the increased level of accuracy and detail from the NHS about the future ambition. And as late September, there was a new press release talking about focusing on advanced products that can really improve the efficiency of the healthcare system and improve patient outcomes, quicker procedures, and so on. So these are all things that are getting more and more detailed and very much in line with what we are able to provide. So I think it's moving in the right direction, but in the quarter it was still weakness in UK.
Thank you. And my final then, which leads me to UK, so down 9% year over year on a reported basis. The comp for the fourth quarter is pretty challenging because you had a pretty strong quarter last year in Q4. I think it was up 14%. But again, qualitatively talk about, when you expect to see more material impact from, the improvement and addressing the long waiting lines in the UK that you anticipate. I think we've spoken about this before, possibly towards the end of the year, but that said, NHS fiscal year ends your calendar Q1. So anything you can share with what you've learned here recently would be helpful.
Yes, thank you for that. Yes, so normally the strongest quarter in UK is Q1 because it's the final quarter of the fiscal year for NHS. So that should be a good quarter as usual. It's really hard to predict how this is going to evolve. We are in general optimistic. We think we have a good portfolio and a good team in place to support NHS whenever they are ready to make these steps that they are talking about. So I would refrain from speculating about that, but I think over time we are positive. We think it's going to improve.
Thanks so much.
Thank you. So thank you, Matthias. And then we move on. Philip, you may have some questions, perhaps.
Yes. Morning, all. Morning, Christina and Fredrik. Thanks for taking my questions. So I'm happy to see the margin improvement. I think you are as well. And I understand this might be difficult, but could you please give us some color on kind of what is efficiency gains and what is a higher share of more advanced products? Could you say something on that, please?
That's a good question, of course. Maybe we could say that, talk about that on a single company level, but in the mix, it's quite hard to actually say what is what there. I think we always work on efficiencies. We always try to keep costs in check and so on. And then again, the evolution towards more advanced products is certainly helping, and efficient price management in both business areas. So I think those are the components, the major components. I think I want to refrain from giving any further detail. I think it's a difficult number to calculate. Is there something you'd like to add to that, Christina?
No, I fully agree. Per company would be possible, but super hard on the total level. So no.
But these are the things we drive, and the companies are taking action in these areas, and so it works that way. But the quantifying is hard.
It makes sense. I appreciate it. So could you say how should we think about this going forward then, and perhaps also if you could add some color on sort of what's the margin differences between the more advanced products and the sort of consumables? You give us the split 70-30. Could you say something about the differences in margins?
Again, these are wide categories, so I would want to refrain from that as well. I think we can all understand that simple volume products with no differentiation, then there is a price pressure, and there is little to do in terms of pricing and so on. It's all about an efficiency and a low cost procurement, right? So we try and stay out of that as much as possible. We try to have our differentiated products. We try to have our own brands and so on. So by doing that, we can actually get the margins into an interesting territory even for the more volume type of products. But I don't want to give a number there either. It will be a question of definition, and we're talking about thousands of products here, literally thousands of suppliers as well.
Yeah.
But higher margins for sure, that's clear. Yeah.
Yep. Got it. Thank you. And then perhaps one final question from my side before I jump back into the queue. So net debt EBITDA below 3 now. My guess is that you're kind of looking to ramp up M&A activity. What are you seeing on the M&A market? Multiples, sort of what's your take on the current state of the market?
Well, I think it's an attractive market. We have been ramping up our activities for almost 2 years now to develop and nurture a nice funnel of targets. I think the companies of the type that we are looking at, the small to medium-sized, preferably companies that we find ourselves through our networks, there the multiples are quite healthy. I think so. We're optimistic about that, and also due to the fact that we can really look across all over Europe to find the targets that we like. That gives us some confidence in in reasonable price tags. I think it's useful to look at our historical multiples that we have been paying. We have been paying at around 6 to 7 times EBITDA. That's been the average for every year, except 1 year where we made some bigger acquisitions, and they were at a higher price tag. But we are back to the small and medium-sized ones. So I think it's fair to assume in the area of 7 times going forward. Depends on the size of the company, the profitability, and various things. But that's a kind of a rule of thumb.
Perfect. Thank you very much. That's all for me for now.
All right. Thank you, Philip. So I think Ulrik, you raised your hand as well. Ready for you, Ulrik, whenever you are. Please don't forget to unmute.
There we go. Hopefully you can hear me now.
Now we hear you. Yes.
Hi, good morning. A few questions on my end, and again, sort of alluding to the previous questions on improving margins, because it's a substantial margin trend that we're seeing, and you have some positive comments on continued progress on this. But if we could take it sort of, what degree have you done tail cutting on low margin products, and to what extent have that sort of excelled your margins, as well as if tail cutting has been done, could we quantify in volume of sales how much that has been?
Yes, there's been a fair amount of tail cutting going on across the businesses. We are pretty diligent about that, and it's the margin, but also margin in relation to inventory levels that we need to keep and so on. So substantial tail cutting there. We did an analysis of that, and so it's what did we conclude? It was around 1%. Yeah.
For this year.
Yeah, for this year.
If we looked at the few of the larger companies.
Yeah, around 1%. So that's that's the ballpark.
And just how much of that sort of 1% have increased your margins?
Well, I think that's a 1% reduction in top line that comes from product pruning and changes in the product portfolio, and then that has helped the margin improvement, right? For sure. Again, a little bit difficult to quantify exactly, but that gives you the magnitude of it.
Okay, great. And on the medtech side, obviously seeing improvements there as well, and you have now included Edge, and it looks like it had really high margins here in Q3. And I know generally Q3 is a seasonally smaller quarter for these type of companies, but what have you learned in terms of its seasonality? It's still early days, I know, but is there any more color you can give on this?
Well, I think Edge is a typical company of the kind that we really like to drive, and so specifically these are products for advanced surgical procedures, oftentimes quite individualized and customized, and primarily planned surgical procedures. So there is clearly a seasonality in there, meaning that these type of procedures are not to the same extent planned for the summer months. So absolutely a seasonality there. And again, Edge is a company with very advanced products. Also, it's certainly not a volume type of profile on that company. So yes, indeed, summer months are weak in general for these types of products, as we well know. Similar situation in Spain and Portugal, for example. So we know that well, but we like that type of company. I think they are super competent, very advanced products, things that really help the patient improve in a significant way. And by the procedures we use to help the surgeons, oftentimes we can also send the patients back home quicker. So that's wonderful.
Okay, great. And last question on my end. You were awarded some new tenders for the lab tech business from Q4 onwards. Just trying to figure out how much of sort of the profitability level on these new tenders versus what you had before, and what to expect in terms of margin expansion going into the next few quarters.
Yeah, I think these tenders were won, a little bit back in time, but they continue to, impact the comparison numbers from previous year. They represent additional revenue when we have won tenders, away from competition. So new revenues at healthy margins, and then the ones that we have renewed have also an updated pricing. So that helps on the margins and top line as well. So they have been continuing to contribute in this quarter as well, along with other things. There's a lot of positives in Labtech this quarter. We see improvements in biomedical and research. We had a strong quarter in Eastern Europe. Usually the third quarter is a bit weak, and then we see a fantastic improvement in the fourth quarter. This time around, we saw a quite healthy third quarter as well, so we're happy with that.
Okay, great. Thanks for taking my questions.
Thank you, Ulrik. So let's see if we have any more questions. Gustav, yes. So we're ready for you, Gustav.
Yes, thank you for taking my question. I thought maybe just to start off with your wording in the report here that you still have a few companies with lower profitability. Assume you refer to AddVision. I guess you're also referring to some else. Are you seeing new companies here, and what's your sort of action plan for those?
Well, I think it's a handful of companies, I would say. We talked a little bit about AddVision. There is room for improvement in some companies in home care as well, some in Labtech, some in AddTech. So it's a few companies across the board. Some of them we have been, working on for quite some time to evolve the business. And I'm pleased to note that, we are starting to see a good trend, and a movement in the direction that we were hoping for. So in most of these companies, it's going well. So of course, can new challenges pop up? Yeah, of course they can. It's a broad group of companies, and we keep a close eye on the development, and we address it rather quickly when things are not going the right way. But again, this is a small group of companies, but I would prefer to look at it as an improvement potential. So that's the way we perceive it, and we're working diligently on that, driven by the management teams and supported by the business unit leaders.
That's perfect. And then just to build on, I think Mattias' question early on with AddVision. I mean, you have given some sort of indications of where margins are sort of mid-single digit, if I recall correctly last time. You still comment on single digits, but should we assume that we are moving more towards, high single digits now, or?
That would be a little bit too early to say that. I think the eye surgery business is also cyclical, like we see in the other surgical procedures. So fewer procedures are indeed scheduled during the summer months. So Q3 is normally relatively slow, and that was the case this year as well. Even though it was markedly better than last year, still a slow quarter. So year to date, this mid-single digit is pretty accurate. So I hope to be able to talk about high single digits, and maybe I will soon, but not quite there yet.
That's great. And then just on your healthcare 21 table there with the growth and profitability, is it possible to give an indication of how much is organically driven?
On healthcare 21 profit improvement. Well, we haven't really. No.
On top line,
I think a lot of it is organic, I would say. So we have made a few acquisitions. Only two of them are bolt-ons, so Emma and Flynn. They have been contributing nicely, but they're not enormous companies. It's more around continuous evolution in healthy product segments. These companies are doing a great job in terms of sales management and very committed teams with a strong focus on their specific specialties. So that's working out well. We have been taking out with some force supplies that are not really meeting our expectations and requirements, and also removing entire product groups that are in low margins. So that has certainly helped as well. So I think as always, it's a combination.
That's very
And
helpful.
normally we
Sorry.
don't want to talk about the details about specific companies, but in this case we did, because I think there are great examples of our ambition or successful steps out into the European market. Also successful, improvements of the performance and a nice platform for future growth. But again, then I don't think we want to give that level of detail.
No, we appreciate that. Thanks. And just the final one, quick one here. I mean, a bit into Q3 and October here. Are you seeing any change in the pattern? Of course, I mean, not compared to the summer holidays here, but I mean, just in a normal scenario, are you seeing any change in demand, so to say?
No, not really. I think it's we haven't focused that much on that yet, but I think we don't see any significant shifts really. You can see that the drop we had in the uptake last year during the summer months was not as deep as it was this year. So that's probably promising for the future as well. I think that's the only comment I can make really.
No, that's great. Thank you very much.
Thank you. All right, so let's see here if we have any more questions. Thanks for good questions, by the way. Do we have any more coming up? See that? Okay, so then we apologize again for the delay here. I hope you got answers to your questions. Don't hesitate to reach out if you want to ask more questions. And now, for those who have time, we show a little bit of a video for Healthcare 21 Ireland. Interesting company and fantastic team. Thank you.
Healthcare 21 gave AddLife a large geographical presence within that northwestern area of Europe, covering many complex healthcare systems. Republic of Ireland, Northern Ireland, Scotland, Wales and England all have very, very different healthcare systems, and Healthcare 21's intimate knowledge of those systems has allowed them to deliver year-on-year successes.
I am so proud to lead Healthcare 21 Ireland. Founded 22 years ago, it was built on a vision that creates 21st century gold standard solutions for healthcare products and services, with our customers at the core. From day one, the caring company was born, and that's the culture that still defines us today. Today we stand with a turnover in excess of 130 million, and we have consistently delivered year-on-year growth. We now operate across 15 specialised therapeutic areas, from primary care, surgical, critical care, imaging, scientific and endoscopy, to name a few. Each of our dedicated teams is passionate and knowledgeable in their own field and have a clear focus on our mission, and that is to improve lives. Today we're really excited to introduce one of our standout divisions, and that's the primary care division. It's a division that has gone from strength to strength and now holds the largest market share in Ireland, a real true example of our commitment to excellence.
We provide one-to-one assessments and carry an extensive range of products to ensure that the right solution is achieved every time, from early intervention to palliative care. These products, coupled with a strong service offering, ensure our clients are supported throughout the journey by promoting independence and enabling them to be the best they can be. I am privileged to manage this team and so proud of their passion, dedication and commitment to providing the best solution for the end user.
Since our foundation in 2003, the primary care team has been one of the key drivers of our growth within Healthcare 21. They've set the standards and set the example for all of us and have done an incredible job. Their deep product knowledge, their market presence has really been second to none. The teams at Healthcare 21 have truly embraced the AddLife culture, including the very clear and simple KPIs that we have. They've worked very hard on inventory, on freeing up cash flow, and on all those other metrics that are so important to us as we reinvest and also deliver to the markets. It's the supplier relationships that Healthcare 21 have helped contribute to the wider AddLife group, sharing our network, sharing our collaborations, and making sure that every advantage that we have within one part of our geography is replicated in another. And for these reasons, I feel Healthcare 21 has contributed not only financially, but also significantly in terms of culture, sharing the ideas, the best practice, the philosophies that have really made Healthcare 21 successful, and look forward to many, many years of future success in this market.